As we begin, let's look at silver's real-time market price. In late December 2025, silver reached record highs above $65 to $69 per ounce, one of the strongest rallies in decades, with annual gains exceeding 130% relative to prior years. This surge has placed silver near or beyond multi-decade peaks, catching the attention of investors worldwide, and setting the stage for what many analysts now call a potential +20% move into the first quarter of 2026. The recent rally is not just a short-term spike. It reflects a deep structural imbalance in supply and demand. For several consecutive years, global silver production has failed to match consumption, a persistent deficit driven by both investment flows and growing industrial use. Reports show that the silver market continues to run in deficit, forcing prices upward as physical stocks tighten. Unlike gold, silver plays a dual role. It's both a precious metal hedge and a critical industrial commodity. This dual demand has become a defining characteristic of the 2025-2026 silver story. On the investment side, global economic uncertainties and expectations of looser monetary policy have fueled strong inflows into silver. On the industrial side, the rapid expansion of renewable energy systems, electric vehicles, and advanced electronics has significantly increased physical consumption of silver. These factors combined have pushed silver prices higher and underpin forecasts for further gains. Through 2025, silver's rally was bolstered by several macroeconomic themes that remain relevant going into 2026. Central banks around the world maintained accommodative policy stances for much of the year, and expectations of further U.S. Federal Reserve interest rate cuts have strengthened demand for non-yielding assets like silver. Lower real yields reduce the opportunity cost of holding precious metals, making silver an attractive option for a range of investors. Market psychology also plays a role. As prices climbed, technical momentum reinforced the bullish trend. When an asset breaks historic resistance levels and holds above key support zones, it encourages additional buying from trend-following funds and retail traders. This has driven silver into territory where it now competes with traditional investment assets in terms of volume and attention. If silver were trading at significantly depressed levels, forecasting continued upside would be a different exercise. But here we start from a position of strength. Prices are at record or near record levels, physical markets are tight, and demand signals remain robust. Under these conditions, analysts increasingly view a +20% move into Q1 2026 as a plausible scenario, not just a speculative headline. Analysts point to a mix of continued industrial growth, persistent supply constraints, and macroeconomic tailwinds that could push prices toward higher resistance zones above $80 per ounce under favorable conditions. One key element in understanding this forecast is the role of physical metals markets, especially ETFs backed by physical holdings. These instruments have seen strong inflows in 2025, removing metal from the available supply pool, tightening physical availability, and reinforcing the price structure. When inventories are drawn down and physical metal moves into long-term holders, the market becomes more sensitive to any incremental demand, which can amplify price moves. Industrial demand cannot be overlooked either. Silver is not a fringe commodity. It is essential for several high-growth sectors, especially solar photovoltaic panels, where silver's conductivity and durability make it indispensable. Electric vehicles also use silver in electrical contacts and circuits, and data centers increasingly rely on silver components for their high-efficiency requirements. As global investment in green technologies continues, this structural demand acts as a fundamental underpinning for prices well beyond speculative flows. The economic times, the interplay between macro trends, technical factors, and industrial realities, has created a market environment in which silver's move above historical resistance levels is not only understandable, but also sustainable within the context of the underlying fundamentals. As we look forward toward Q1 2026, analysts point to several interconnected drivers that could amplify this trend. Continued expectations of monetary easing in the U.S., sustained safe haven interest amid geopolitical uncertainties, and delayed supply growth, particularly from mining output constrained by cost challenges, all contribute to a scenario where prices could move meaningfully higher. At the same time, it's important to emphasize that volatility remains elevated. Silver has historically shown larger price swings compared to gold, partly because its physical market is smaller and less liquid. Rapid shifts in sentiment or unexpected macroeconomic developments can trigger sharp corrections even within broader uptrends. But within the context of a sustained rally, These movements are part of the normal risk profile investors must assess. The Economic Times. For investors and viewers watching this video, a plus 120% move does not mean a guaranteed outcome. Markets are inherently uncertain and influenced by a range of dynamic factors. What it does mean is that based on current data and credible analysis from multiple sources, silver's price structure, demand drivers, and supply constraints align with a scenario where higher prices are statistically plausible within the next few months. Before we continue into part 2 of this series, where we will break down potential risk scenarios and practical investment frameworks, let's reflect on what we've covered so far. Silver's record price levels in 2025, the structural forces driving demand, the macroeconomic backdrop of 2026. In a correction scenario, prices retreat meaningfully but remain above key long-term support levels. Corrections do not signal failure. They reset positioning, reduce speculative excess, and often create healthier conditions for future stability. For disciplined investors, such periods are about risk control, not panic. As we continue, it's critical to shift from momentum and optimism into risk awareness and analytical balance, because strong markets are never one-directional forever. Silver's current position near historic highs automatically changes the risk profile. When prices rise rapidly, the margin for error narrows, and even fundamentally strong assets can experience sharp pullbacks without breaking the long-term structure. One of the primary risks facing silver at these levels is profit-taking pressure. After a multi-year rally that accelerated through 2025, many institutional and long-term holders are sitting on substantial unrealized gains. In commodity markets, it is normal for such participants to rebalance portfolios, lock in profits, or reduce exposure once prices move far above historical averages. This does not require bad news. It can happen purely due to portfolio discipline. Even in structurally bullish markets, periods of consolidation are healthy and common. Another key risk comes from macroeconomic recalibration, particularly around interest rates and currency strength. While expectations of easier monetary conditions have supported precious metals, markets constantly reassess these expectations. If inflation data surprises on the upside or economic activity remains stronger than expected, interest rate expectations can shift quickly. In such cases, the US dollar may strengthen temporarily, which historically creates short-term pressure on dollar-denominated commodities like silver. This does not invalidate silver's long-term demand story, but it can introduce volatility that investors must respect. Volatility itself is an important topic. Silver is structurally more volatile than gold because its market is smaller and more sensitive to changes in industrial demand, speculative positioning, and liquidity flows. This means price movements, both upward and downward, tend to be sharper. For investors, this characteristic is neither good nor bad by itself, but it requires proper position sizing and risk management. Silver rewards patience, but it also punishes over-leverage. Supply dynamics also deserve a balanced view. While the market remains in deficit, higher prices eventually incentivize additional supply through increased mining activity and recycling. These responses are slow, not immediate, but they are real. As prices stay elevated, previously uneconomic projects may become viable, and scrap supply may increase as holders choose to sell. This acts as a natural stabilizer over time and can limit how aggressively prices move without pauses. From an industrial demand perspective, silver remains essential, but it is not immune to cyclical slowdowns. If global manufacturing activity softens, or if certain green energy investments slow due to policy changes or funding constraints, industrial consumption growth may decelerate. This does not imply collapse. It implies that growth rates matter. Markets price expectations, not just absolute demand. Now let's discuss analytical scenarios, not predictions. Scenario analysis helps investors prepare mentally and strategically, without claiming certainty. In a continuation scenario, silver prices remain supported by strong investment demand, steady industrial consumption, and tight physical availability. In this environment, prices may test higher resistance zones gradually, accompanied by volatility but supported by fundamentals. Momentum remains constructive, and pullbacks are shallow and bought. In a consolidation scenario, silver trades sideways within a broad range. This is common after sharp rallies. Prices may fluctuate for weeks or months as the market absorbs gains, allows indicators to cool off, and lets fundamentals catch up. This type of market often frustrates impatient traders but strengthens long-term structure. In a correction scenario, prices retreat meaningfully but remain above key long-term support levels. Corrections do not signal failure. They reset positioning, reduce speculative excess, and often create healthier conditions for future stability. For disciplined investors, such periods are about risk control, not panic. Silver remains one of the clearest asset classes because it represents a tangible, real-world commodity with intrinsic utility. Physical silver ownership, allocated storage, and fully backed instruments align with asset-based principles. The key requirement remains transparency. Avoiding excessive leverage, interest-based exposure, or speculative instruments detached from physical reality. Risk management is especially important in halal investing because preservation of capital and avoidance of unjust enrichment are core principles. This means avoiding emotional decision-making, avoiding chasing price spikes, and maintaining diversification rather than concentrating excessively in a single asset, no matter how strong the narrative appears. For portfolio construction, silver is often viewed as a complement, not a replacement for other assets. Its role may include diversification, inflation protection, and exposure to industrial growth themes. The appropriate allocation depends on individual risk tolerance, time horizon, and overall financial structure. There is no one-size-fits-all approach, and disciplined investors adjust exposure rather than reacting impulsively to headlines. Another point often overlooked is liquidity planning. Investors should always consider how easily an asset can be converted back into cash if needed. Physical silver, while valuable, may require time and proper channels to liquidate efficiently. This reinforces the importance of planning ahead rather than making decisions under pressure. As markets move into early 2026, silver's story is no longer about discovery. It is about evaluation. The metal has already proven its relevance. Now the focus shifts to sustainability, balance, and risk awareness. Markets at elevated levels reward discipline more than excitement. To summarize this second part without overstating outcomes, silver's current valuation reflects powerful forces: investment demand, industrial necessity, and macroeconomic conditions. But elevated prices naturally bring higher sensitivity to news, data, and sentiment. Understanding both upside drivers and downside risks allows investors to remain objective rather than emotional. This analytical approach is what separates informed participation from speculation. Silver does not need hype to justify attention. Its fundamentals already do that. What it does require is patience, clarity, and respect for market cycles.